And when we return, it'll be time to set sail.
Wow! What just happened? What kind of question is that? Can't you see? Wow! That looks like a brand new SUV. What kind of vehicle is that? What kind of question is that? Can't you see? Was it the motorcycle that caused it? Or the cooling van? What kind of question is that? Can't you see? But why is that man smiling and pressing his phone instead of pressing that careless man's face against the car's floorboard? And what kind of question is that? Can't you see? But what kind of man is that? Wait, seriously, what kind of man is that?
Yes, that's the kind of man that has prepared for the unexpected. The man that knows that when accident happens, ICO Auto Insurance Plan keeps you covered, so you don't have to worry. Get the ICO Auto Insurance Plan today. Call us on 0700 iContact, that is 0700 2442 668228, or visit www.icoplc.com to learn more. ICO Insurance, your stable friend, yesterday, today, and always.
Sun, through the rain, and a friend you can trust all the way, every day. Live your life, we've got your back, and so I will take you there all the way, every day. Yeah, stability assured.
ICO Insurance, your stable friend, yesterday, today, and always.
Lagos Traffic Radio 96.1 FM. Insurance on the Move is a program we set for the conversation this evening. But the updates that are coming in a little bit worrisome, especially those of you coming in from the 3rd Mainland Bridge. By the time you descend the bridge heading towards Yanowuru, I understand it's a slow one from Yanowuru proceeding towards heading towards Alakbare. And what is responsible? I understand filling station MRS within that particular location. It's where the situation is, and that's affecting your movement this evening. All right, it's a rainy day. The rain came pouring in earlier on, and so we're having some flooded portions of the road. For you to avoid that, if you're just coming in from the island, you might want to make use of a co-bridge as an alternative to link up with the Korodu Road, and then you can proceed on your journey. All right, we'll be serving you more helpings as they come in from time to time. But let's return to that conversation on, the principles, some basic insurance principles, why insurers do what they do. Like I told you earlier on, we've started this for over 3 weeks now, and we need to get things sorted out, especially this week. All right, so let me bring Shadrack Adegoke of ICO Insurance straight away to the microphone. Shadrack, good evening.
Yeah, good evening, Mr. Victor.
And how are you doing?
Very well, thank you.
All right. For 2 to 3 weeks now, we've been dwelling on the basic principles as guiding the practice of insurance. So, to refresh our memories a bit, what are these principles? Let's just run through them again. What are the list of the principles?
All right. So we have the principle of utmost good faith, or obrema fidei.
All right.
Principle of insurable interest, indemnity, contribution, subrogation, loss optimization, and of course, COSA or proxima.
Right.
Nearest cause.
Okay, so I know that we'll be able to deal with utmost faith. We've talked about that, what it is, and where you have issues of fraudulent non-disclosure and innocent non-disclosure. I know we've reflected on that.
Of course.
We've also talked about the principle of insurable interest. And you did say that if I do have any interest in something, it's not proper for you to insure it, no matter how close that friend or perhaps
financial interest.
There must be a financial interest that is guaranteed. And we've also reflected on the principle of indemnity, right?
That's correct.
We talked about that last week, and I know you dealt with it extensively. But there's something I want to bring to your attention, Shadrack. Just before we rounded off the program last week, I know that somebody sent in a message. That's Comrade Daniel. He sent in a message, and I would like you to quickly deal with that before we touch on the next principle. And he was saying, I'm going to read his message. He said, good evening, Victor and your guest. My friend bought a Toyota Camry for 3.5 million naira 3 years ago and sold it for 5.4 million naira recently. Now, if he insured at the current price, after looking at the depreciation value, how much will be his compensation? That is coming from Comrade Daniel Onobume.
All right, thank you. So that question came when we discussed the concept of depreciation, that insurers will depreciate the value of the vehicle in the event of a total loss before payment is made. So if the vehicle is insured for 5.4 million, which is the current price, and let's say, for example, it is destroyed by fire or it was stolen, the insurers, depending on the number of years, depreciation is a function of the number of years that the vehicle has been used. For a vehicle that is within 3 months old, from the time the insurance commences, they may consider like 2.5%. Between 3 to 6 months, some say like 5% depreciation on the vehicle. Then 7.5 for maybe 9 months, and then maybe 10% in some cases for 1 year. However, we have also seen that the maximum depreciation that is usually obtainable in the market maximum is 20%, and we have seen in some cases where it is even 10%. So it's a matter of personal engagement with your insurers to determine the level of depreciation that will be applicable on the vehicle.
All right. I hope that answers your question, Comrade Daniel. But if not, you can always reach us during the course of the program. So let's quickly switch on to the next principle, and that is the principle of contribution. Shadrack Adegoke, explain this for us. How does it work?
So contribution is the right of an insurance company to call upon other similar but not necessarily equally liable to the same insurer to share the cost of an indemnity. The principle of contribution enables total claim to be shared in an equitable or fair manner. The doctrine of contribution operates as a corollary of the doctrine of indemnity, and hence it is applicable in case of general insurance only. As per the doctrine of contribution, the indemnity provided for the loss occurring on the asset which is insured with several insurers has to be proportionately shared among them according to their rateable proportion in terms of how much the asset was insured with each of those insurers.
All right. So that's the way it works. All right. I need you to just explain a bit further for me now with an example for the benefit of our listeners. So if you're going to give an example that would portray the principle of contribution, what would that example be?
All right. So when you talk about contribution in insurance, it is contingent on the fact that there are 2 or 3 underwriters that are insuring the same assets.
Oh.
I have a car.
Okay.
I insure it with insurance companies A and B, the same vehicle. Let's say, for example, for the same amount.
Oh, okay.
So there was a fire, for example, that was both covered under the policy. The owner files a claim. He may even decide to file the claim with the 2 companies. But if they discover that the policy has been insured with 2 different insurers, the principle of contribution will come into play. How does it come into play?
Tell me.
Insurance company A will go ahead to settle the claim, less the policy excess. Let us say it's a total loss, that is destruction by fire. And then it will now subrogate against insurance company B. In other words, the insured has insurable interest, the insured also has subrogation right. The insured will now bequeath its right of subrogation to the insurance company A, which has settled the full value of the claim, which means the insurance company A can now take on the responsibility or the right of the insured to hold the negligent party or the other party, other insurance company accountable, and then they will now share the loss on the basis of the level of insurance cover that the insured has put on the vehicle when they were insuring. If you insure it for 5 million naira with company A and then 5 million naira with company B,
right.
The implication is that once if company A has paid the 5 million naira, it can go to company B, and company B will now share that's like 50%.
From company B.
You can obtain, collect 2.5 million naira from company B as their own part of the contribution towards the payment of the claim.
All right.
But the crux of the matter is that the insurer cannot get more than the value of the vehicle at the time of a loss. That is what indemnity is based on.
Right. Okay, that's for indemnity, right? What about but this is contribution, right?
Yeah.
Okay.
Yeah.
So what are the conditions under which this principle can work?
All right. So the principle of contribution can work. Before it works, there must be more than, like I said, one policy involved. And all the policies must be covering the same subject matter of insurance. More than one policy must be enforced, and the two policies must be covering the same subject of matter of insurance. For example, maybe it's the vehicle or the house. Then all the policies must also cover the same peril causing the loss. If the cause of the loss is fire, then the two policies must cover fire. Then all the policies must also cover the same interest of the insured. So the insured must have financial interest in the subject matter of insurance that was insured with the two companies.
Right. Lagos Traffic Radio 96.1 FM. We're looking at principles governing the practice of insurance. And Shadrack Adegoke is our guest this evening. He's taking us to the classroom. All right. I think we've dealt with the principle of contribution effectively now, right? So we can switch on to subrogation. Is that correct?
That's correct.
All right. Maybe before we do that, let's just take a short break. We'll return. This is Insurance on the Move. And if you have any questions for Shadrack this evening, feel free to connect with us on 080-99-120-777 and 091-5387-7127. A brief break. We will be back.
Honestly, I am fed up of my street.
Hey, what's wrong now?
I think my street is jinxed. Over the weekend, my apartment was boggled and the criminals made away with valuables. They even took my son's toy treasure box.
Stable and reliable.
And just this morning, there was a huge fire incident in my neighbor's house and he lost everything. I mean everything.
Wow. Anyway, like I said before, stable and reliable.
What are you saying? Are you mocking me?
Abba, of course not. I just said
obtainable, portable, blah blah blah. I can rhyme too. It doesn't help my situation.
Okay, you remember I had similar experience last year, but thankfully I had signed up to a fire and burglary insurance plan with a stable and reliable partner, ICO Insurance.
Oh, now I get it now.
Yes.
But why didn't you tell me all this while now?
When the unexpected happens to your home appliances, ICO provides the insurance cover that makes you worry-less. Get the ICO Fire and Burglary Insurance Plan today. Call us on 0700 iContact. That is 0700 2442 668228 or visit www.icoplc.com to learn more. ICO Insurance, your stable friend. Yesterday, today, and always.
Lagos Traffic Radio 96.1 FM. Insurance on the Move is a program. And of course, still have with me Shadrack Adegoke. All right, then Obanikoro. Okay, let me see. What's the latest here? Okay, trying to see if I can sort that one. But those of you coming in from the 3rd Milan Bridge, did tell you that you have it pretty slow by the time you approach Alakpore. Nothing unusual. It's just the filling station there, MRS, dispensing fuel. And so we have lots and lots of influx navigating through that particular corridor. Most other areas, even though it's busy, steady movement can be sighted as you move from one location to the other. All right, Shadrack, let's talk about the principle of subrogation. What does it mean?
So subrogation in insurance is a term that is used to describe a legal right the insurance company holds to legally pursue a third party that is responsible for the damage caused to the insured. Now, in simple language, when an insurance company pays you the amount you claimed in a situation where a third party was responsible for the damage in question. You subrogate your rights to the insurance company. Subrogate is to bequeath your right to sue or hold accountable the party negligent or responsible for the loss. So this means you give the insurance company the legal right to sue that person who caused the accident to recover the money paid to you for the damage.
You mean it?
That's correct.
Why do they need to do that? I thought the agreement is that if you hit me and you have the policy document, your insurance company goes ahead to settle. Why do you need to go after the person that caused the accident? Why do you need that?
All right. So what is important is that you get settled, your claim is paid. Now, it is important that anyone that is negligent and whose act of negligence has resulted in the loss of somebody's property, such a person should be held accountable. And that is one of the reasons why we have the Third Party Insurance Act in the first place. If you check it very well, you will notice that the Third Party Insurance Act is actually interested in third party losses alone. It's not concerned about comprehensive or about your own accidental loss or damage to your personal vehicle, but the loss or damage you cause to a third party. The government, even the government, is interested in how we handle ourselves and how our actions impact others. So, if there are no consequences for bad habits to third party, it may cause unrest in the country.
All right. So, if your policy contains the clause that says waiver of subrogation, what is the implication for the insurance company?
So, this is a contractual provision where I'm talking about the waiver of subrogation. In that kind of situation, you are saying in the event that the loss to my vehicle, for example, is caused by my wife's car, don't hold her accountable. That is essentially what that law says. So if there is a clause in your wife's car and your vehicle and your wife's car that says if it is caused by my wife's car, you cannot say that you want to now drag my wife and say, come and pay for the loss your car has caused to your husband's car. So in that kind of situation, the underwriter has waived his right to now say, oh, madam, it's your vehicle that destroyed your husband's car, so you need to pay. That is what we mean by waiver. That right has been waived by the insurance company.
All right, then. Let's quickly talk about one more before we begin to take some of the reactions that are coming in. Let's move to the principle loss of minimization. What's that?
Okay, so the principle, as per the principle of loss minimization, it is the insured's duty and responsibility to take all actions to minimize losses if it is within their control. Emphasis on if it is within their control. It should take all necessary steps to control and reduce the loss if possible. Imagine there is a fire in the car, for example. If the car is insured, the insured person cannot just sit and relax thinking that, after all, my car is insured. He will get the claim for sure. If it is in his control, he can try to control the fire using the car fire extinguisher to quench the fire or call the fire department for help. But it is not expected that he will just sit down and say, oh, okay, I have insured this vehicle. That is why it is expected that all insureds should have this sense of responsibility to their property and treat it with a sense of delicacy, so that they will not be seen as, I have taken insurance, I can do whatever I like. You should act as if you are not insured. That is the principle.
A flash update coming in says the broken down mini truck at Agege, that's a broken down mini truck at Odoeron inwards Oba Ogunji Road, which was due to a mechanical fault, has been taken off. So it's a much better movement if you are navigating through that particular corridor. All right, then 08099120777. That's the numbers that you can connect with us this evening. If you have any questions for Shadrack as we dwell on some of the principles guiding the practice of insurance. And some of you are sending in messages right now. Let me see if I can just run through them within the limited time that we've got. This one says, Good evening. Says, how are premiums rated and what factors play a key role in this process? This is coming in from Amaka. So, how are premiums determined under, when you talk about the principles of insurance? Yes.
All right, thank you very much. So, let's take insurance of a building, for example. If you want to insure a building, some of the things that the underwriter will want to know is the location of the building.
Okay.
Sometimes they might even be interested in how flood prone is that environment, because one of the things that are covered by fire insurance against building is flood.
Yeah.
So if it is in an area that is prone to flood, then the underwriter might want to now say, oh, okay, you will pay more than what somebody whose house is located in a place that is not prone to flood is going to pay. Then they may also be asking questions surrounding the culture around the location where the house is. I don't want to mention places, but there are some places that when you hear of their name, they will say, oh, okay, these are the set of people that live in this kind of environment.
Right.
Any little escalation can create a big problem, and so on and so forth.
So insurance will determine that as well.
So these are some of the things that they will take into consideration when, there are so many other things, but because of our time, I may not be able to mention them.
All right, this one says, Mr. Shadrack, can you explain how risk pooling works in insurance industry?
All right, I think we answered something similar about it
last
1 or 2 weeks ago. Yeah.
Okay.
So the concept of risk pooling in insurance is the insurance company is a custodian of all the premium that are received from insureds. So what we do is, for example, motor insurance. 1,000 people have private vehicles and they pay maybe 100 naira or 1,000 naira individually into a pool that has been set up by the insurance company. So the insurance company is essentially a manager of the pool, and the premium is usually determined on based on some assumptions that, maybe in a year there will be 2 total loss claims, there will be 3 total loss claims, there will be partial losses like 10 or 15. So all of these have been taken into consideration in determining what the premium rate is. So eventually, when that pool has been put together,
right,
it will become a huge amount, such that if 1 or 2 or 3 people have losses within a year, they will take out of that money that has been pooled together, to settle their claims.
Okay. All right. This one says, good evening, Victor. Please, what is the report on Ikorodu Road? Ikorodu Road is still looking good for the return journey this evening. It says, how do insurers decide which risks are insurable and which are not? Muiwa from Stadium. He sent that one in.
All right, thank you. So even insurance companies, like I said, they have their own insurers. We call them reinsurers. They are the insurers of insurance companies. So there are usually contracts in terms of these are the things that are guiding the operation or the contractual relationship between insurance company A and their reinsurer. So they would have stated that these are the things that you must cover. These are the things that we can cover. These are the things. So if you want to do anything outside the things that are within the scope of your reinsurance contract, you want to check it very well again if it is something you can retain within your book. Otherwise, what you do, the wise thing to do will be to say, I'm sorry, I do not have appetite for this kind of risk because it is outside the scope of the reinsurer. And I said 2 weeks ago that the reinsurers carry like 90% of the risk. So if I take on any risk and there is a big loss and the reinsurers are saying, no, this is not part of the things we said we're going to protect you against, then that means you're on your own.
Okay, let's quickly talk about the last principle before we round things up in less than 2 minutes. The principle of causa proxima, or in simple terms, we call it principle of proximate cost, right?
That is cost. That is correct.
Talk to me.
Yeah. So proximate cost means active, efficient cost that sets in motion a chain of events. It's an active, efficient cause which has set in motion a chain of events which brings about a particular result without the intervention of any forced state and working actively from a new and or independent source. So that is proximate cause.
Okay. So how can it be applied? Quickly. How does it work rather?
An insured sustain an injury, for example, let us say an insured sustain an injury in a motor accident, and he was admitted to a hospital. Now, while the treatment is being taken at the hospital, he contracted an infectious disease, which caused his death.
Wow.
Don't forget, the reason why he went to the hospital was because of
accident.
an accident,
Right.
a minor accident for that matter. But unfortunately, while he was at the hospital, something else came on, and that thing led to his death. There have been cases like this in the past, and the court held that the approximate cause of the death of that person was not the accident, but the disease.
Okay.
And the original accident was merely a remote cause. So as such, the claim is not payable under personal accident insurance. So from the above discussion, explanation, it is quite evident that insured is allowed to recover the loss from the insurer only when the loss has been caused by a peril that has been insured and the cause has been proximate to that particular loss.
All right. I wish we can continue this conversation, but time is not really our friend. But we've been able to touch on all the principles, so to say, majorly, about 6 of them. Is that correct?
7.
7. There's 7 of them. All right. So we have a contribution, we have indemnity, we have the principle of utmost good faith.
That's correct.
We have the principle of contribution as well.
That's correct.
We have the principle of proximate cost, which you just mentioned now. And which other one again?
Loss minimization.
Loss minimization.
And subrogation.
Subrogation. All right. So one of these days, we're going to get back to the quiz table and we ask you some of these things as well. Some questions are still popping in for you, but no time to really take them. I must say a very big thank you to you. Shadrack, Adegoke, thank you so much for being here.
It's my pleasure.
All right, then. So we've been able to run all of this up, and then we'll switch to another policy that we'll be discussing next week. The program this evening has been produced by Akan Hussein, and I say a big thank you to Definite Media Concept for putting all of this together. Next Thursday, 6:30, the program makes a return. But till then, I am Victor Oteri. Have a splendid evening. Bye.